Hello and welcome to this very special edition of Indianomics. The Indian economy and equities are possibly at an inflection point. While GDP growth is almost touching 8% this year, at least the first 3 quarters have, the equity markets have been notching fresh highs with some regularity this year. The rupee is a picture of stunning stability, and Indian bonds have already rallied 5% this year and look set for a big year ahead, what with inclusion in not just the JPM index, but also in the Bloomberg index. In addition, there is an important election round the corner, which promises to usher in another term of stable politics and policy making. It's a great time to have an investor conference, and that's exactly what the Citi India team has been busy with. Their investor conference comes up on the following Monday and Tuesday. Joining me to speak about the conference and their view on India's markets and macros are Aditya Bagree, the head of markets at Citi India, and Surendra Goyal, the head of equities at Citi. Gentlemen, thank you very much for your time at what should be a very busy last working day before your conference begins next week. So thank you for sparing your time.
Thank you for having us here.
Sure. Well, Aditya, for starters, I'm excited by the fact that now 2 indexes include us. What's your view actually on yields itself? It looks like everything is going for a bond investor.
I think very true. To be fair, Latha, I think we are very constructive on Indian bond yields. I think starting from the fiscal deficit number as well as the gross borrowing that was announced by the FM, I think it took the market by surprise, and we did see the market react to it, right? We were trading around 715, 720 in the 10-year IGBs. Now we are closer to 705. I think the 14.1 lakh crore of gross issuance can easily be absorbed by the market. Plus, at the back of all these bond index inclusion, we are expecting just from a passive flow almost $25 billion to come in, right? And if you include the active flows, maybe closer to $30 to $35 billion. So we think that bond yields, just given by the demand supply dynamics, can go down to maybe 680. And if towards 680,
okay,
right? In fact, we think if RBI starts cutting rates or gives an inclination that rate cutting is on the horizon, I think it can go down even further to maybe 6.5.
Okay. Well, we had a report from Samiran, and he was on the channel. He's not expecting it till I think October. So there is some time, but nevertheless, 680 is mouth-watering for anyone looking for capex, plans. But that's the point, Surendra. Are you seeing enough capex plans? When you approach the equity market, would you pick capex candidates?
Yeah. So yes, we do like that sector. The only thing we would add here is that the recovery is gradual. Okay, it's a slow, gradual recovery, but all the preconditions for capex that are required, they have all been in place, right? COVID kind of pushed out things a little bit because capacity utilization across industries went down. But now we are kind of back up there. So definitely feels like a much better place to be in. Like, what are all the usual preconditions that are required? They're all in place. Capacity utilization across the system has been increasing. The only thing we need to keep in mind that it's unlike the previous cycle, which is what people always end up comparing it with, right? Where we had like 4 or 5 very high years of growth.
Of infra growth.
Infra growth. So I think it will be a lot slower and moderate, but I think everything is moving in the right direction.
But,
and some of these businesses, like more as stocks, they have gone through a fairly prolonged slowdown. So as they come out, the growth is also accompanied by operating leverage, which from an earnings perspective is translating quite nicely for investors. And that is where we continue to like the sector.
Okay, so what would you pick? Would you pick stocks like L&T? I don't know if you're allowed to name names, but is it that kind of stocks? The PSU utilities are doing very well. Which is your, where would you train the viewer's eye?
Yeah. So we actually like both the segments of the market. If you look at our reports for the sectors where we have overweight stance, both of these sectors figure. Okay.
That is capex and
as well as PSU utilities. And I think it's a combination of multiple things. I think it's where valuations are in context of the broader market, the kind of growth outlook, right? I think when you put it all together, these sectors still compare quite favorably. And some of these sectors, like PSU utilities, for example, also benefit from the fact that for multi-years the level of interest in these sectors has been low. So they started with a fairly high level of under ownership, and as people kind of kept bridging that under ownership, the stocks have really done very well.
So, it's a big fear of small caps. Would you worry about which kind of PSU utilities you're picking up?
No, absolutely. Which is why I mentioned the point that we are selective. We would be careful because definitely in certain pockets in the small cap and micro cap space, you feel that there is a lot of optimism getting priced in.
Okay.
And I think to that extent, one needs to be cautious here. If you look at the kind of flows that we have seen in SMIDs in the last 14 months or so, they have been very strong, right? Yes. So definitely there are pockets where we feel there is too much optimism. The fact is that SMIDs have also delivered better earnings. Okay. So to some extent it's justified, but there are pockets of exuberance which we will be careful about.
Okay. Well, Aditya, tell me about the cost of capital for corporates. If the Indian government is going to borrow as low as 6.8, do you see a rush of corporate bonds? Will that market become active again?
So I actually think even currently, right, if you look at the corporate bond spreads, they're quite tight. The 10-year PSUs are trading at almost 40 basis point spread to Government of India bonds. So at 705, PSU bonds trade at around 725, right? Even NBFC's name are trading at around 750 to 760. So the corporate bond spreads have stayed tight after COVID, right? When there's a rush of liquidity in the system. I do think
as you get to 6.8,
right,
then you're going to have even more attractive yields for.
Absolutely. I think from a spread perspective, maybe you will see some widening because all this inflow that is going to come and the demand dynamics which is going to be there is going from Government of India bonds, right? Having said that, I mean, corporate bonds is also going to benefit. There will be a crowding in, right, of investment in corporate bonds because a lot of the supply will be taken over by foreign investors. And so from a local investor's perspective, they'll be able to deploy that in corporate bonds. So I do expect corporate bond yields to also come down, maybe not as much as Government of India bonds, but definitely yes.
Okay. What about the rupee? If you're going to have $40 billion, counting active and passive and Bloomberg and JPM, right. Do we see some? I mean, we have seen, which is a usual scene in the Jan-Feb-March quarter. At least we are starting to see 82 point something. Right. But does it get any stronger?
So again, very constructive on rupee side. We don't know if there will be a lot of appreciation, right? We actually think that from a balance of payment perspective, maybe we will see about $45 to $50 billion of surplus for India next year. Having said that, we think RBI might look at adding back to the reserves, right? Keep growing it. So you might not see a big appreciation in rupee, but it might just trade within this range.
Okay. Well, actually, I've forgotten about your conference. Surendra, what can you tell us about the conference in terms of its attractiveness? Are you seeing a fresh batch of FPIs or funds, sovereign wealth funds interested? What's the audience like? Or what's the interest like?
Absolutely. So we are seeing very high interest. And I'll maybe share two things. Firstly, about the conference. We have around 200 clients registered for the conference, out of which 80 are investors from overseas. Oh. That kind of tells you about the interest. And the second thing I would mention is that we, even like when I was in the US, say a couple of weeks back, we are seeing a lot of interest from international funds. And when I say international, what I mean is world ex-US. Okay, and in this benchmark, India is now 5% of their benchmark, which say 3-4 years back used to be 2 percentage points. And in the same small cap benchmark, India is now 8% of the benchmark. And these are investors who may not have spent a lot of time on India in the past because the exposure or the percentage was relatively small. So we are seeing a lot of interest in India, and which is kind of reflected in the conference as well. The number of investors, the kind of investors. The other thing I can tell you is we are getting a lot of people who are either looking at India for the first time or kind of were looking at some other EM or Asian countries mainly. And now because India is becoming more important, they are also spending a lot of time in India. Okay. So I think it's a combination of all those things.
Okay. Aditya, you want to add anything in terms of specific themes that you all may be exploring in the conference?
So, just to add to what Surendra said, right? I mean, last year we actually did these road shows all over the world, talking to both investor clients as well as corporate clients and talking about the whole India opportunity. I don't think.
How is it different then?
So I don't think I have seen this level of interest in India in last 20 years that we saw this year or last year, right? Partly I think it's just because how strong the macro fundamentals are in India, partly because everyone is looking at China plus one strategy, they're looking at diversifying out of China, and India is one big strong market that they're able to see. Just one more thing I do want to add, says Surendra, and you brought up the conference. We are also expecting Jane Fraser, our global CEO, to attend this conference. So yeah, that just shows interest that we have not only from
And the
banks
importance
and
given
importance.
to
Exactly.
the India equity story and the India economy story. Well, we have to take a break on that note, but I do want your views on a whole host of other sectors, Surendra, and you on what you make of what's happening in the global ecosystem and whether that might spoil our bond picture. All those questions after the break. Welcome back to Indianomics. This is a Citi India special. I've been speaking to the brains trust of Citi India, the head of markets, Aditya Bagree, and the head of equities, Surendra Goyal, on their upcoming Citi India conference and all the important themes that they will be discussing there. Thank you very much, Aditya and Surendra, for dropping into our studios in the first place and for your patience. Okay, Aditya, you said that you see Indian bond yields going to 6.8, but can the Fed spoil the picture? Quarter after quarter, the growth over there is better than what the economists forecast and better by like 1 percentage point, much like our country. So do you think the Fed moves can be pushed out into 2024?
It's a very good question, Latha. I mean, I think the question that everyone is asking whether US is going to be able to achieve a soft landing or whether it is
that is good for rephrasing the question, yes,
right, or whether it is going to be a hard landing. To be fair, I agree. I think the recent data has been stronger than what the market was expecting, but we think you will start seeing some cool off on the data going forward. From the Fed, the inflation number that Fed normally focuses on is core PCE, right, which has gone down all the way to 1.9%, has come up to around 2.5%. I think it does give room to Fed because the real rate, even comparing 2.5% inflation, is 300 basis points, which is quite high. But I think the number that they will be focused on is more employment or non-farm payroll, right? So if that starts cooling down and if that leads to growth coming off, I think Fed will get some room to start cutting rates. Okay. Even if you look at from a markets perspective, right? I mean, if you look at the last Fed dot plot, I mean, they had projected only about 75 basis points of rate cut. The markets was actually projecting a lot more, but they have readjusted, and now market is pricing in only about 100 basis points of rate cut this year. So not a big difference.
Yeah, at the most, the disappointment may be another 25.
Exactly.
But Aditya, what are the chances that the yield, the 10-year yield doesn't oblige? Because the fiscal deficit, if you extrapolate from the October, November, December quarter, is still very high in the US. The issue of treasuries may still be very big. So how do you see the US 10-year behaving? And if it goes towards the 4.2 or 4.5 mark, even then our yields can fall?
See, I don't think that's our base case scenario. I mean, and we have seen some of the correction already happen, right? The 10-year yield went up all the way to 4.4. Yes. Now it's come back down to 4.2. Our base case is it will come back down to around 3.9 kind of a level. We also think from a reaction perspective, markets will react more favorably to softer data than to more hawkish data going forward. So there's a better chance that if the employment number or the NFP, which is expected this week, I think last number was 350,000 new jobs. We are actually expecting it to come off significantly closer to like 150,000 new jobs being added. And if something like that happens, we think yields can fall in US.
Okay. Well, I wanted to ask you about how you look at financials, therefore. If the Indian yields are coming down, how do you look at banks and NBFCs? Is that a favored sector?
Yeah, so I think you have to look at everything together, right? Where valuations in that sector are is also an important parameter to look at from a stocks perspective. So near term, the business outlook is definitely a bit muted, no doubt about it. But when you look at all the large sectors in India, they are trading well above their historical levels as far as valuations are concerned, right? While financials as a sector is at or below the median kind of level, right? And if you are kind of thinking about it slightly longer term, it's very difficult to have a situation where the economy keeps on doing so well and financials kind of keep on struggling. So our view is that this is a good chance to add some of these names, right? Particularly on the private banking side. These are businesses which have compounded very nicely over the years. And this is one of those opportunities where for people with a medium-term time frame, this is just a chance to add exposure to that sector.
Well, the other thing is, speaking about soft landing and the US growth surprising on the upside, how are you looking at IT companies? Surendra, actually, I remember you first in your IT analyst avatar. Some people have already started calling a sell, saying that some of the stocks have gotten too pricey. Your view?
So we turned cautious more than a couple of years back, and since then we have not yet turned positive.
Okay.
I think it's a combination of lot of things. See, firstly, I think you pointed out that last year's growth in the US surprised, right? But if you look at the IT services companies in India, the growth at the start of the year, people were expecting high single digits. If we are ending the year closer to, say, 3%, even at an industry level, if you take the top 10 companies. So clearly there has been a negative surprise. And what is that coming from? That's coming from uncertainty in decision making, right? So while the macro data has been positive, corporates are still very cautious because there is a lot of uncertainty. So on the discretionary spending side, you are seeing a lot of caution, right? Now, as we go forward from here, it still looks like a slow recovery. I think the macro uncertainty has to ease. We really need to see a path of clarity that, okay, this is what the macro is going to look like, right? And if you look at the macro data, 2 weeks you feel that, yeah, things are trending in this direction, and the next 2 weeks it's on the other side. So I think that clarity needs to emerge, and we are also cautious about a couple of other headwinds. Okay, see, firstly, global capability centers, or GCCs as they are commonly called, you are seeing a lot of growth there.
Stiff competition too.
Yeah, so again, like while clients do demarcate the spending, but to us it definitely feels like GCCs are playing in the part of the spending which is seeing better growth. Okay, so that's point one. And secondly, the industry just keeps on getting more and more fragmented. So if you compare, say, 6-7 years back, a lot of the smaller players today were not relevant when it came to, say, $25-50 million deals. So when you put it all together, it's still a challenging backdrop, and that kind of explains our underweight stance on the sector.
Actually, speaking about your entire year's target also, you said some good weeks, some bad weeks. 22,500 is your, end of year target.
That's right.
But you expect an overshoot, I mean, when, say, election results come or in the run-up to the election results?
Yeah, so see, that could always happen. The only point I would make is, see, the market did capture a fair bit of upside post the straight election results end of last year, right? Today, where we sit, everything is looking quite decent, be it the economic growth, earnings growth, financialization
difficult to find
of
the
savings.
negative picture.
The only thing I would still be careful about is the valuations are also pricing in a lot of these positives, right? When you look at market at 20 times earnings at a 90% premium to other emerging markets, then you really want to see at least either earnings surprising on the upside, or else if you just think about it, right, since the start of this year, the market is up 2%, right? Despite all the positives. Right. So you could just have a period of consolidation and then people get more comfortable. We could easily go through that phase. Okay. So that's how we are really thinking about it.
What kind of earnings growth are you expecting in FY25 itself?
Yeah, 25 is more in the range of 14%. Actually, 25, 26, if you take those 2 years, we are in the 13-14% kind of CAGR band, which is pretty healthy going by the past standards.
Oh yes, the past decade, we
were at high single digit or thereabouts, right? So in that context, it's still very healthy, but it feels like that valuations are at the higher end and they need to moderate a little bit for better entry points. Okay. And again, so our view is that firstly, buy any dips, and secondly, there are opportunities in a market which where at a headline level, there may not be a lot of upside. So that's how.
Certainly, as you pointed out in the private banks, where you said that you will buy the dip. Well, a final question to you. I know we get carried away in equity markets. Aren't the debt markets in for some very interesting times? I mean, if so much of foreign money comes in, some 40 billion or 30 billion, there will be more hedging activity. The Reserve Bank also is pushing banks, away from, relaxed views into, accounting standards where they have to hedge more. So do you think the debt market has a lot of legs to run in terms of volume, sophistication?
I think it's already happening, Latha. To be fair, I think the debt markets in India, if you look at the spreads at which the bid-offer spreads that they trade, I think it's one of the tightest in the world, right? So from a liquidity perspective, I actually find Indian debt markets to be decently liquid. Uh, and I agree. I think with more foreign money and foreign interest starts coming in, we normally see that there are certain on-the-run bonds that tends to perform very well, while the other off-the-run bonds stop trading after some time, right? But with all of them getting included in the FAR bonds, and there will be continuous interest from foreign investors to keep buying these bonds as they rebalance, right? So we definitely see a lot more liquidity in the market at the back of it. Also, I think the domestic institutional investors have kept getting larger and larger, right?
Insurance, pension.
Exactly, right? I mean, so earlier, I think a large part of the total government bond issuance was subscribed by banks, and they used to hold it as part of their SLR portfolio. But we actually see insurance and pensions becoming a big part of the total market and taking up a lot of duration, especially the 30, 40, 50-year bonds. That all shows how the bond market has been developing. So I actually see one way for the bond markets to go from here.
That's very important even for the lay investor. Debt mutual funds went into a dip when the tax advantage was taken away. But I would urge all of you to listen to what Aditya is telling us, that 6.8 on the 10-year Government of India bond will mean that there is a lot of legs to run even for corporate bond, and therefore for bond mutual funds. Of course, equities is a game that everyone knows, and as Surendra says, even if the end of the year is going to be 20,500, there could be overshoots through the year. Thank you very much, Surendra and Aditya, for dropping by, and I hope you have a great conference.
Thank you, Latha.
Thank you.